Welcome to TheoTrade. This is Don Kaufman. Here we are. It's March 25th, 2017, doing the weekend update. First and foremost, volatility. That is pretty much the word out on the street right now. So first couple of signs of volatility emerging in this previous week of trade. So that's what we're going to look at a bit first and again foremost, and then moving forward, of course, we're going to be looking at not only the present, what the risk is right here, right now, but we're going to be extremely forward-looking to the coming week. We're also going to talk about a couple of the intraday trading opportunities. For those of you guys that do trade intraday, it's alive and well once again. We're getting some pretty sizable ranges. So let's get right to it here in the SPX. I think it's one of the best places to start. So we had what we'll call a bit of a tumultuous trading week over here with some decent sell-side activity coming in on Tuesday. Now, for those of you that know and tune into TheoTrade quite often, I happen to be a bit of a bear. I kind of wear that position out there, on a day-to-day basis. I'm very steadfast with my positions. I'm a bear. This turns out to be a fairly good week. At the first sign of volatility, I'm almost excited. But let's not get ahead of ourselves. So we have one nice down day followed by a couple of range bound days. However, those ranges were quite considerable. The single most important thing that I want to get to, so all volatility, everything aside, the single most important thing, the SPX this past week exceeded the expected move, and it's been a very long time. You got to go back to December 7th to see us kind of smoke through an expected move. Now, let me bring you back exactly to that. To do that, so let's get off the chart. All right, so the S&Ps were here and now they've dropped to here. Well, great. That's Captain Obvious kind of stuff. Let's go to the analytics tab on thinkorswim. And in fact, I'm even going to close up this left side bar. So when I say back up on the week, so here we are on the 25th. Let's actually back up to the 19th. Okay. I want to back up an entire week because I want to display ultimately where the market began the week was 2378. All right. So let's highlight a couple of areas here. The market actually, last week, 2378, we all know it dropped into the 2340 range, neither here nor there. What the market was anticipating risk to be with 5 days. So we're actually going back to last weekend and we're saying based on last weekend, forward looking, what were we supposed to do? We're supposed to make basically a 25-point move. So if you do some quick math over here, it's plus or minus roughly that 25 bucks. So we're expecting us to come down to the neighborhood of about 23, maybe 53 to the downside. And obviously we went down this week, 23.53. However, and again, this is one of the first times we've exceeded it. We're at 23.43. And what was really quite entertaining to watch is that every time that we went outside of this $25 move, the volume in the S&P futures started just to explode. It was like, oh! This is the first time this has happened, again, since December 7th when we had an explosive move to the upside. So we breach the downside of the expected move. What does that really mean? Well, first of all, it means one thing that I've been talking about now for months. Don't sell premium in that low of volatility or you're going to get run over. I mean, it's like a game of Frogger right now if you want to sell options premium. And unfortunately, you're the frog about to get hit by the truck this coming week. So forget about the past. We know that we exceeded the expected move over here, which again, it's the first time it's happened in quite some time. Close up that left side bar. It's more important right now to be forward looking. So Friday's trading session brought some fairly extreme volatility, and I want to bring you right to it. Before I start, digging into here and be forward looking, I want to explain what actually occurred a bit on Friday. And for that, we're going to start to look at some intraday trade. So I'm going to bring up the S&P futures. And with those S&P futures, I'll go to my intraday kind of quad over here. By the way, this is a study that we openly share. So if you want the study, in fact, we're even going to do a webcast this coming Tuesday, March 28th. I'll discuss it toward the end of this. So if you want the indicator, because it's the first time I've really showed it on one of these videos here. It's just a quad tick. It shows you the tick, the advanced decline line, highest advanced, okay, lowest AD. Ultimately, you've got the breadth over there, the average advanced decline, but the ticks themselves are actually color coordinated, which I will explain a little bit in the webcast coming up. What I really wanted to display, though, was the sizable range that you saw inside of trade on Friday. Now, clearly a lot of this was, all politics aside, the healthcare vote. So it was on, it was off, they pulled the bill. Doesn't matter. Okay, we saw some really wild trades start to pick up, and it wasn't just on Friday. Some great intraday opportunities presenting themselves, but this wasn't just Friday. If you guys watched a little bit throughout the week, what I just brought up happens to be 30 days of trade. So I wanted to explain a little bit. 30-day, 1 hour, and the reason is, and it really is exemplified in this chart, how serious some of the intraday volatility started to get throughout the course of this week. However, we're resting below a very key risk level for a lot of trading firms. Okay, so moving forward, right here, that line that is drawn across the screen, okay, and I want to elaborate upon this. This is 2349. It's 2349 inside of the S&P futures. I talked about it in a video earlier this previous week. 2349. Think of 2349 as almost like gravity, okay, to the marketplace. So it's fairly evident that trading firms have a substantial amount of risk right in this neighborhood. When we sit, okay, to 2349, their risk is relatively happy, but it's literally drawing the markets like gravity to it. When we start to trade above or below that 2349, we explode in terms of volume. Well, we're about, again, a few handles, that's a few points below the 2349. It would make sense coming into Monday, probably tag into it. Anything solidly below that, and the market can really start to accentuate a bit of a downward spiral. So in taking a look at this over the last 30 days, everybody keeps asking me, like, what's the next stop to the downside, right? Just throw out big round numbers, 2,300 if we're actually going to trade and trade down. However, when we start looking at what's the upside opportunity, the downside opportunity over here, okay, so I just wanted to exemplify some of the intraday trade over here and some of the volatility that we saw. But when you start talking about all right, where are we going to go? And this is important, okay, this coming week. So the volatility was seriously elevated. But then, of course, on Friday, they pulled the healthcare bill and some of the volatility came off. Or did it? So one thing I want to display to you is that this option that we're looking at right here, that's the March 31st option. Okay, it first of all is the end of a quarter. In addition to it, it's still sitting with a 14% implied volatility and a $36 expected move. Now, I mean, how does that really compare to this week? So now we go to the SPX, and again, all I'm doing is coming back to last Sunday. I know this is kind of confusing because I was talking about where we're going to be this next Friday, right? I was talking about March 31st, but let's go back to what risk looked like on March 19th. Well, I'll tell you what, risk this, from last weekend, we had like a $25 expected move. Okay. If you want to go back to the week before that, we can go the week before that. And what did risk look like that week? Well, risk that week, we had like a $27 move being priced in. Okay. Go to the week before that, the week before that, what are we ultimately looking at? When I say the week before that, you're all the way back to like March 5th. Well, that was a $19 move or a $20 move for the entire trading week. All I'm trying to say is everybody's like, oh, that's it. They pulled the bill over here. Do not get off your guard over here, okay? The interesting thing was, even though they pulled the bill, the market may not like this, okay? And the volatility dropped for the Monday expiration. So what's kind of cool about the SPX, you have a Monday expiration, a Wednesday expiration, a Friday expiration. They dropped the vol for Monday, okay? But they actually kept the vol packed in for Friday, because there's some news announcements and so forth that are going to be out this week. When I talk about news announcements, I'm becoming less and less into watching any news in any way, shape, or form, because frankly speaking, it's just not helping anymore. By the time the news is out and you can actually read it, that has already been disseminated into all the order flow. And the reason there's additional volatility packed in there, there's like GDP numbers coming out. Yeah, those can get a little bit serious out there. Nevertheless, okay, the market sees it and it's anticipating about 14% implied volatility. Ladies and gentlemen, is the highest volatility we've seen, okay, in a very, very long time. Does that mean that Don would run out and sell options premium? No, and I'll tell you exactly why I wouldn't sell options premium. Do some quick math over here. $36 takes us very, very close, ladies and gentlemen, to $2,300. So let's say, for example, that we see some sell-side activity this week. We crack through 2,300 and it's all over but the crying. And that expected move takes us right to the cusp of that. And if I were you, be a little nervous coming into this week, okay? Now, let me show you why, okay? I'm absolutely leaning a little bit more to the bearish side over here. However, I think that we could see some rip and rallies. They got to have these traders come in and buy the dip over here. For that, let me go to the XLF. The XLF, all right, and now we're actually going to take it down again to some intraday trade. The XLF rallied on Friday, failed, kind of bounced back up a little bit towards the close over here. But one thing I want to kind of accentuate is, if you're not familiar with the XLF, which is of course the financials, has had a fairly substantial sell-off now. Okay. In fact, I'm going to take you down to a 3-month chart on the XLF, and I want to take this into a percentage view. I was doing this a bit earlier in the week. So here's the XLF up 7% and now is down about 0.3%. So for the most part, it's had approximately a 7% slide. One of the areas that is extremely disconcerting, okay, is right here. These are all failed attempts, okay, at a bounce. And that's what you really want to see is, if it's going to bounce, it needs to bounce. And again, I want to show you now numerically on the screen. By that, I mean, let me take off the percentage. You want to see a bounce, okay, back right here to this 24 handle, right? So you want to come bouncing right back into the 24 handle. And that would be, again, hey, we had a wild down day Tuesday. Don't worry. Okay, we bounced off of it over here. There's absolutely no bounce. The volume's starting to increase. Okay, you got to watch the XLF carefully. This product and this product alone ultimately can take down a very large portion of the S&P 500. The banks, they don't look good. They're not bouncing over here. And again, multiple failed attempts to bounce, and we're ultimately closing towards the lows of the week out there inside of the XLF, which is, to me, one of the single most important areas. With the financials looking very, very weak, let me go over to the bond market, because I've talked extensively about the bonds lately, okay? It's always been my interpretation, if the market's going to sell off, that the bonds are going to rally. Sure, there's an opportunity eventually for the bonds to sell off, but in the end, if trade gets scared, they're going to be buying the bonds. Well, guess what? They've been buying the bonds. We've been bought up from 145 back to 150. These are wild times over here, okay? We want to watch this week. You get any upward momentum in the bonds, okay? Put your helmet on, get underneath the desk over there, because we're going to be going down. At this point, again, I have been one of the few people, I'm really bullish on bonds and have been bullish on bonds. I took bullish positions in the TLT this week on the bonds, and people, where do you think the bonds could go? If there's any sell side activity throughout the course of this week, you'll see the bonds spike right back up to like the 157 handle. Think I'm crazy over there, right? 6-7 point move. Come on. You saw the slightest sign of fear this week, all right? And bonds shot through the roof. But bonds have already been rallying before the sell side activity comes in. Therefore, watch bonds carefully. Those bonds rally, okay? It doesn't matter what the S&Ps are doing. If the bonds rally, duck and cover, okay? Because things could get a little bit nutty out there. All right, so there's some other areas that are starting to become disconcerting. So we got the bonds that have been rallying kind of day in and day out. We've actually got the XLF that can't get out of its own way. But what came alive a bit throughout the course of this week, for those of you that do look at skew. So let me bring up, I've got a special skew style just for this, okay? What skew is the out of the money puts versus the out of the money calls. Skew remains elevated to record levels. That just means that a lot of traders are hedging out there. It's pretty evident. On top of it, the VVIX, the volatility of the volatility index. Check this out. That's the VVIX from Friday. I mean, this got insane. If the VVIX starts getting above 100, once again, that's like, duck and cover, get underneath the desk kind of stuff. It backed off down to 90, but on a percentage basis, these are alarming moves. Okay, I want to mention that again. On a percentage basis, the moves inside of the volatility are starting to get a bit more alarming, and you need to keep an eye on volatility overall in the marketplace. Okay, where are we? Again, moving forward. The expectations this week are for increased risk. You really do have to keep an eye if we start to sell off on the 2,300 mark. I'm picking a big round number, but that big round number does correlate quite nicely with the fact that the expected move takes us very, very close to the 2,300 marker out there. You got to keep eyes, of course, on the bonds. If the bonds continue to rally, all right, it's going to put pressure forth to the XLF. The XLF is likely to take the S&Ps down. And I'm going to reiterate something that I talked about earlier in the week. Everybody wants to know, what, again, I anticipate the largest, you got to have an appetite for risk this, but the largest, in terms of percentage moves out there, what do I see as being most advantageous right now? It's not in the S&Ps. I talk about the S&P because they drive order flow to the rest of the marketplace. But the reality is, once again, okay, right here. And if you don't like the Nasdaq futures, go look at the Qs. Okay, the opportunities inside of the Nasdaq right now, I mean, they're incredibly good. And what's the opportunity? It's a short opportunity. I mean, you have to look at the Nasdaq, and here, just zoom in for a second to the last 3 months. This thing's just off its all-time highs. So you look at the Qs, compare that to IWM, right? IWM, well, that's already gotten whacked back quite a bit. Compare it to the spiders, all right? The spiders, well, they got whacked back. They're still off, but the Qs, they've been unscathed. When you start looking at, stuff like Google, you go, gulp. All right, here's one of your largest market caps inside of the Nasdaq that has been bruised and beaten in the last few days, okay? Hasn't filled up this gap over here. Come on, I said that for you market technicians. Keep an eye on it. Now, let me switch gears on you guys completely. In the coming weeks, I'm going to be talking extensively about intraday trading. When I talk about intraday trading, okay, I'm not talking about sitting in front of your computer all day long, glued to the computer screen over here. This coming Tuesday night, it's Tuesday, March 28th at 7 p.m. Central Time. Okay, you can go to the web address TheoTrade.com/intraday. I am going to be discussing an upcoming class. Okay, this is a preview of that class. Okay, whether you're going to go to the class, you have got to check this preview out. If you are a member of TheoTrade, okay, come check out this class on Tuesday, March 28th. The intraday trading class is going to be on April 8th. However, at this presentation, we are also going to present to you, okay, we're actually going to give everybody this Theo Quad. This is an intraday indicator, right? And we're going to give everybody that indicator at the time of the webcast over there. And I'll take you through a little bit about the webcast and what we're actually going to do. So again, this is a preview of an upcoming class, and I'm going to do a tremendous amount of education in this class to provide you some footing for the April 8th class. But it's how to generate, okay, high probability outcomes with intraday trading setups. And that's one of the first things I'm going to talk about is what's a high probability outcome for an intraday setup? Well, for the most part, we're actually going to use options for intraday trading. Okay. We're also going to discuss being right less than 50% of the time and still receive consistent trading results. I'm actually going to show you that here momentarily. And all of this, you don't have to sit in front of the screen all trading day. Okay. Of course, if it's intraday trading, you got to glance at the trading screen. Here's also another one. I spent 15 years in the brokerage industry, so I'm going to show you how to circumnavigate day trading margin restrictions using alternative products over there. And again, everybody's going to receive the indicator, okay, prior to coming this March 28th. And again, I want to elaborate upon the link over there is TheoTrade.com/intraday. Okay, we will have a class following this on April 8th. I'm going to get through some phenomenal education in this March 28th hour, okay? In addition to it, on April 8th, every member of TheoTrade, okay, is going to the April 8th class. We do approximately one class per month. In March, I actually did a class, and Doc Severson did a class, but April 8th, I'm actually going to be kicking off the class, and it's going to be an intraday trading class. I'm pretty excited about it because we haven't done an intraday trading class yet here at TheoTrade. So if you're a member, of course, you're going to the April 8th class. If you're not a member of TheoTrade, it's fine. Check out what we're going to be talking about. You're not going to be disappointed. And one of the things I'll show you really quick that I'm going to talk about and kind of accentuate during this hour, I'm going to go to the Analyze tab here. And I'm actually going to bring you over to the spiders, okay? And I'll just give you, again, quick and dirty example here. All right, go to the spiders. And of course, we'll open up a few more strikes here in the Analytics tab. I'm going to open up like 30 strikes. And one example might be, I was talking about, being right, for instance, 50% of the time, or, are you even right 50% of the time in the marketplace? So take a look, okay, at an option. Now, if you have no options experience whatsoever, it's okay. On Friday morning, yesterday, on Friday morning, you could have purchased this option for roughly $3, okay? And what option is that? Well, that option would have been the 131 calls. So you can basically purchase an option for $3. One contract is going to cost you $300, okay? There's no way if you purchase that option, you can't lose more than what? Than $300. But what I want to show you is if the market rallied, for example, what would you make? Well, your $3, if the market rallied, the 231 calls would be worth what the 230 calls are actually worth right now. So your $3.03 would be worth right about what? Okay, $3.93. So what would you have made? You could have made about, let's say, 90 cents. You would have made right around 90 cents. However, what happens if you're going to be wrong? Well, your $3, if you're wrong, would be worth right about here, what these 232s, okay, were worth. So how much would you lose? And the answer is, right in the neighborhood here of about 80 cents plus transaction costs. This is just a prime example, okay, of, people get all hopped up about intraday and, there's indicators and so forth. We're going to give you indicators, but the simple example over here, let's say you're in the market and you're right about 50% of the time. Well, in this example, when you're right, you make 90 cents. When you're wrong, you lose 80 cents. There's actually edge for the trader. And we're going to elaborate upon, during this Tuesday's class, we're going to elaborate upon how the right trading strategy, okay, in many cases is more important than the indicators that you might use on an intraday basis. But we're also going to introduce some pretty phenomenal indicators out there. Go to theotrade.com/intraday. You won't be disappointed. Again, Tuesday, March 28th, 7 p.m. Central Time. Thanks, everybody, for joining us at TheoTrade. Have a wonderful weekend. Bye-bye.